Have you ever wondered how the complex labyrinth that is the stock market came into being? Our story begins in the 17th century, in a bustling city known as Amsterdam. Here, the concept of a centralized place for trading shares was birthed, and the Amsterdam Stock Exchange, the world's first true stock market, was established. Initially, the stock market was a means for businesses, particularly those embarking on risky but potentially lucrative ventures, to raise capital. These firms would issue shares of their company, essentially pieces of ownership, to investors in exchange for funds. This way, they could accumulate the necessary resources for their endeavors without bearing the entire financial risk themselves. Now, imagine being an investor in the 17th century. You've just purchased shares of a company embarking on a treacherous sea voyage to trade spices in the East Indies. The ship could return laden with exotic goods, bringing you a handsome profit. Or it might sink, be raided by pirates, or get lost, taking your investment with it. This was the risk and reward dynamic that characterized early stock markets. But as time passed, the stock market evolved, becoming more complex and sophisticated. It began to serve not just as a platform for raising capital, but also as a marketplace for buying and selling shares of existing companies. This allowed people to invest in the success of a company long after its initial establishment, and companies to continue raising funds as they grew and developed. Moreover, the stock market began to reflect the overall economic health of a nation. Stock prices became indicators of a company's, and by extension, a country's economic prosperity. A thriving stock market signaled a booming economy, while a plummeting one often heralded financial turmoil. The stock market also became a barometer for investor sentiment, as prices rose and fell based on the collective optimism or pessimism of investors. Thus, it morphed from a simple fundraising tool into a complex, dynamic ecosystem reflecting the interplay of economics, psychology, and sheer human ambition. Thus, the stock market was born, a place where businesses and investors could meet and trade. So, how did the stock market become a global phenomenon? Well, the growth and expansion of stock markets around the world is a tale as old as time. As nations started to recognize the power of public companies and the value of diversified investment portfolios, stock markets began to pop up around the globe. In the heart of Europe, the London Stock Exchange emerged in the late 17th century, creating a hub for international finance. This establishment became a model for others, demonstrating how a regulated market could foster economic growth and prosperity. As we cross the Pacific, we find ourselves in Tokyo. The Tokyo Stock Exchange, established in the late 19th century, played a pivotal role in Japan's rapid economic growth and industrialization. It helped channel the savings of the Japanese people into productive investments, fueling the rise of mighty corporations. And then there's the Big Apple. The New York Stock Exchange, established in the early 19th century, transformed the United States into a financial powerhouse. It acted as a magnet for global capital, attracting investors from around the world, and played a crucial role in funding the nation's growth. These key markets, among others, interconnected the world in a web of trade and investment. They became the pulse of the global economy, their ups and downs reflecting the health of nations and their industries. But these markets weren't isolated islands. They influenced each other, creating a ripple effect. A surge in London could boost confidence in Tokyo, and a slump in New York could send jitters around the world. They created a global financial ecosystem where the fate of one could impact the fate of all. These markets also became the playground for multinational corporations, where they could raise vast amounts of capital from investors scattered across the globe. They became the meeting point for businesses seeking capital and investors seeking opportunities, shaping the global economy as we know it. As a result, the stock market became a global entity, with multiple markets interacting and influencing each other. But how did we move from physical trading floors to online trading platforms? That's a question that has a fascinating answer centered around the evolution of trading methods. In the early days of stock markets, trading was a very physical affair. Traders would gather on the floor of the stock exchange, shouting out their orders in what was known as open outcry. This was an environment of controlled chaos, filled with hand signals and hoarse voices, where fortunes could be made or lost in an instant. However, As the volume of trades increased, this method became unsustainable. The first significant shift came with the introduction of telephone trading in the mid-20th century. Traders could now place orders over the phone, expanding their reach beyond the trading floor. This method was quicker and more efficient, but it was still limited by the number of calls a trader could make or receive in a day. Then, in the late 20th century, we saw the onset of a revolution that would forever change the face of stock trading: the advent of online trading. The internet made it possible for trades to be placed instantly from anywhere in the world. It was no longer necessary to be physically present on the trading floor or even to make a phone call. All you needed was a computer and an internet connection. Online trading platforms began to spring up, offering a range of tools and resources to help individual traders make informed decisions. These platforms made it possible for anyone to trade, regardless of their location or level of experience. The stock market was no longer the exclusive domain of Wall Street brokers. It was now accessible to anyone with an internet connection. This shift to online trading has also increased the speed and efficiency of the stock market. Trades can be executed in milliseconds, and information is available in real time. This has made the market more volatile, but it has also created opportunities for those who can keep up with the pace. Thus, technology has transformed the stock market, making it more accessible and efficient. Can you guess the influence of economic events on the evolution of the stock market? Well, let's dive into the past. Picture the Roaring Twenties, a time of economic prosperity that was abruptly halted by the Great Depression. This era was marked by a catastrophic crash in the stock market, leading to a prolonged period of economic downturn. This devastating event highlighted the need for regulation to prevent such a catastrophe from happening again. As a result, the Securities and Exchange Commission was established in the United States in 1934. This regulatory body was tasked with protecting investors, maintaining fair markets, and facilitating capital formation. Now, fast forward to the late 90s, an era characterized by the dot-com bubble. This period saw a rapid rise in equity valuations fueled by investments in internet-based companies. However, the bubble burst, leading to a drastic drop in stock values. This event led to changes in the way investors and regulators approach tech stocks, emphasizing the importance of solid business models over mere speculation. Next, let's revisit the year 2008, a year that witnessed a severe worldwide economic crisis. The collapse of large financial institutions, the bailout of banks by national governments, and the downturn in stock markets around the world were all part of this crisis. This event led to a re-evaluation of risk management in financial institutions and a reformation of financial regulation. So, what can we learn from these events? Each major economic event has left an indelible mark on the evolution of the stock market. They have led to changes in regulations, trading practices, and investor behavior. They have taught us that the market is not always predictable and that it's essential to have safeguards in place to protect against potential downturns. Economic events have played a significant role in shaping the stock market, leading to changes in regulations and practices. These events serve as reminders that the stock market is a dynamic entity, constantly shaped and reshaped by the tides of economic change. So where do we go from here? What does the future hold for stock markets? As we stand on the brink of the third decade of the 21st century, we can only speculate about the future of stock markets. However, based on current trends and technological advancements, we can make some educated guesses. Firstly, we can expect increased automation. Trading algorithms and robo-advisors are already commonplace, and their usage is set to grow. These algorithms can process vast amounts of data in split seconds, making decisions based on complex mathematical models. This could potentially lead to more efficient markets with reduced human error. Secondly, artificial intelligence, or AI, will play a significant role. AI can analyze patterns, predict trends, and make trading decisions all in real time. It can even learn from its mistakes, constantly improving its performance. This could revolutionize trading strategies, making them more precise and potentially more profitable. Next on the horizon is blockchain technology. Blockchain could provide a decentralized and transparent system for trading. This could lead to lower costs, faster transactions, and increased security. It could also democratize the market by making it available to anyone with an internet connection. But remember, With every new technology comes new challenges. The increased use of AI and automation could lead to job displacement in the financial sector. There are also ethical considerations regarding the use of AI in trading decisions. And while blockchain promises transparency and security, it also comes with its own set of issues, including regulatory challenges. But one thing is clear, the stock market of the future will be shaped by technology. It will be faster, more efficient, and possibly more volatile. It will continue to evolve, just as it has over the past 4 centuries. While no one can predict the future with certainty, it is clear that the stock market will continue to evolve and adapt to new technology and economic changes.